Hey everybody, Dr. Phil here. This is going to be a fairly short video, I hope, on accounting for long-term assets. So let's go ahead and jump into it. So the first thing we'll talk about is plant assets. So what are plant assets? So by definition, they are tangible in nature, i.e., you can touch them. They are actively used in operations. Basically, we're not trying to sell them like inventory. Expected to benefit future periods. We call them property, plant, and equipment. Sometimes you'll hear the term PP&E. You might be sitting in a meeting and you hear one of the accountants say PP&E. Just means property, plant, and equipment. So four issues with plant assets. The first thing is to compute the cost. Turns out to be relatively straightforward. Number two and three deal with the use of the plant asset. So like once you bought it up through when you sell it, allocate the cost to the benefits, the periods benefited, kind of the matching principle in play again, account for subsequent expenditures, and then ultimately record the disposal. So when you get rid of it. So cost determination, the purchase price is kind of a given, right? But it's not just the purchase price, it's also the any expenditures needed to prepare the asset for its intended use. So think about things like shipping, freight, installation costs, maybe like raising land to prepare it, etc. So as it says, this is kind of the key to go by. Acquisition cost includes all expenditures necessary to get the asset in place and ready for use. So, like as an example, machinery and equipment. So obviously the purchase price, kind of a no-brainer. But we could also include the taxes we paid, any transportation charges, insurance while in transit, and then any costs associated with installing, assembling, and testing the machinery or equipment. Buildings, not too dissimilar. Again, cost of purchase or construction, depending on if you're buying or building it. Title fees, attorney fees, taxes you're gonna have to pay, and potentially any brokerage fees. So you kind of get the pattern here, like the cost of the asset itself, and then there may be some ancillary costs you can throw in there too. Okay, land improvements. So these are things like driveways, fences, lighting systems, parking lots. And now what we do with these is we depreciate them. They're going to be on their separate useful lives, but we're going to depreciate these over whatever useful lives we've determined appropriate. Land is so the key for land, and it's written down here, is land is not depreciable. Land does not go now. The things on the land could go down, but the land itself is not depreciable. So for land, we could include the purchase price, like always. Again, some of these you're going to see kind of overlap. Title insurance, legal fees, property taxes, surveying fees, real estate commissions, so on and so forth. Now, what happens if you buy what we call a lump sum purchase? So maybe like you got the land and the building, and you're kind of like, all right, well, I know I just paid like one fee. I just got one cost associated with this. So how am I going to like apportion it? So we do it based on relative market value. So the easiest way to kind of do this is by our example. So it says CarMax paid 90,000 cash to acquire a group of items consisting of land, which it was worth 40 grand, and a building at 60. The 90,000 cost will be allocated on the basis of the appraised values as shown. So we know that we paid 90,000. So the total value, of course, is 100. So we kind of got a deal in that sense, right? We basically got 10,000 off. So what we're going to think about is we're going to take 60% of the 90 grand. You can see down here a portion cost 54,000, and then 40% of the 90, which is the other 36. So that's kind of how we would just add up the amount, the 40 and the 60, 40%, 60%, and then just multiply those two percentages by the 90 to get our 54 and 36. If you look in the bottom right, you can see, well, how does that go in the books? Debit to buildings, again, asset account, increase with a debit to land, same thing again, asset account, increase with a debit, and then a decrease to another asset account, cash, so it's credited for 90, because obviously where money is leaving, right, we're paying 90,000. So depreciation is probably a term you've heard before. It's something we all deal with in our personal lives. Think about the car you're driving around. It's going down in value as you put miles on it, wear and tear. So depreciation in accounting anyway, in accrual accounting, is defined as the process of allocating the cost of a plant asset to expense in the accounting periods benefiting from its use. This is a good example, an exemplary example of the matching principle. Why did you buy the machinery? To help you generate revenue. What do you have to match revenue with? Expense, and for how long? So it just depends on the useful life of the equipment. So once we buy the asset, its acquisition cost, of course, belongs on the balance sheet. It's our asset, ours is in a business asset. And then the cost is allocated to expense over time, again, matching revenue with expense. And that's going to go to the income statement. So factors in computing depreciation. So we really need three things, and I'm going to show you examples of all these. We need to know the cost, easy enough. The salvage value, that's kind of an estimate, and the useful life, which is again is also kind of an estimate. So there's really three methods we'll look at of depreciation. Number one is straight line. That's the method that about 76% of businesses worldwide use. So that's good because it's very simple. Two, units of production, that's more of a function of how much you use the asset. And then declining balance is more of a it's a kind of good method for tax purposes because it depreciates a lot kind of early on. So we got some information here. We'll use these for the examples. We got $10,000 cost. They're going to have a salvage value of 1,000. So they're basically going to depreciate it from the 10 down to the 1. So we're going to depreciate 9. And then we've also on the right, it says useful life, accounting periods, 5 years. And then or units inspected, 36,000 shoes. So we'll kind of keep that in the back of your mind as we work through these examples. So for straight line, we just take the cost, 10,000, minus the salvage value, 1,000, divided by the useful life, which it told us for 5 years. So we have a depreciable cost of 1,800 per year. So every year we basically debit depreciation expense, and then we credit accumulated depreciation machinery for 1,800. And we just do that every year for 5 years until we've gone from the 10,000 cost down to the 1,000 salvage value. So here you can, if you want to pause this for a second, take a look at this. This is just showing you the depreciation schedule. You notice the depreciation expense in red, 1,800 every year. We're depreciating 20% of the 9,000 every year, the 1,800. And then the book value. So think of the book value on the right here. Just think of that as the cost minus whatever the current depreciation is being. So like 10,000 minus 1,800 is going to give us the 8,200. Minus another 1,800 is going to give us the 64, so on and so forth, until we get down to the 1 at the end of year 5. So units of production. So there's really a two-step process here. The first thing we do is we calculate the depreciation per unit. Now I'll just go back real quick. The per unit was the units inspected was a number of shoes. They plan on inspecting a total the 36,000 shoes. Just think of that over like the whole life of the machine. So, and then step 2 is just the depreciation per unit that you calculated in step 1, multiplied by the number of units produced. This will make more sense when we get to the example. So if we look at, if we're just plugging in our numbers, the cost minus the salvage value, we know it was 10,000 minus 1,000, there's your 9. Total units of production, 36,000. So basically for every 1 unit or shoe we inspect, we should depreciate it by 25 cents. The question then is for number 2 is just, well, how many units did you inspect? So here you can see we plugged in our 0.25. That will, of course, remain invariant. So they apparently inspected 7,000 shoes. So we have a cost of $17.50. And then here you can see the schedule for this one. Now, what's driving this is the number of units, right? Because that's changing each year. Notice the depreciation per unit is 0.25. That's not changing. It's just that what's driving the depreciation expense in red is just the number of units produced. Okay, and then the book value, again, it's the same, the original cost, and then minus the accumulated depreciation. All right, so for declining balance, we really got 3 steps. This is the most, I'm not going to say the most complicated. This is the least easy. I like it. It sounds better that way because it's not that difficult. So what we do here is the straight line rate is, if we know it's 100% divided by the useful life. So in our example, if you remember that first method we looked at, the straight line, it was just 5 years. 100% divided by 5, as in 5 years, is 20%, and it's just going to be double that. So that's where they're getting the 40% from. So then so for the depreciation expense, it would just be 40,000 times the 10,000 that we paid for it. So in year 1, we would depreciate 4,000. So you can see that here, like 10,000 times 40%. So immediately at the end of year 1, the value has dropped 6,000, down to 6,000, I should say, 10 minus the 4. And then it's just going to be 6 times 40% is 24. So you're generating big depreciation expense charges early on. And then once you get down towards the bottom, they're obviously a lot less. The only other thing I'll say about this one is be careful of the last year. The last year is basically a plug number. So like you get down to the end of 2024, you've depreciated it down to 1296, right? So all you need to do then is, well, we know at the end of year five, it's got to get to 1,000 by the end of year five. So you can just put in the 296. If you try to do the 1296 times 40%, it's going to be close, but it won't be exact. So just remember in the last year, it's just that plug number. So in this case, to get from 1296 at the end of year four to down to 1,000 at the end of year five. Now, what if you buy an asset? Because let's be honest, most companies aren't buying assets on January 1, right? That would be too clean. Business life doesn't work that way, right? So what if they're buying assets during the year? So this is where we employ the partial year depreciation. So when a plant asset is purchased or even sold during the year, depreciation is calculated for the fraction of the year the asset is owned. So again, we got the same information here in the blue that we already used. So let's say that we bought the machinery on October 1. Think about that. That's like 3/4 of the way through the year. So we only have a quarter of the year left to depreciate: October, November, December. So again, 10,000 cost minus the 1,000 salvage value divided by 5 years. Now that if you before that gave us the 1,800, but remember that was for 12 months. This is only for three. So basically times 3/12 is going to give us that 450. So that's all you have to do. Now, what about changes in estimates? You notice, like when we started this example, I said, yeah, two of the three, the salvage value, and the useful life are estimates, right? That's what we think is going to happen, but we don't know that. So the predicted salvage value and the predicted useful life, these of course are estimates. So over the life of an asset, new information may come to light that indicates the original estimates were inaccurate. That does happen. So let's take a look at the machinery from the last example. And let's assume that at the beginning of the asset's third year, its book value is 6,400. That's the 10,000 cost less the 3,600 accumulated depreciation. That's of course using the straight line depreciation, the first method we looked at. At that time, it's determined that the machinery will have a remaining useful life of 4 years, and the estimated salvage value is going to be revised down from 1,000 to 400. So a change to the salvage value and a change to the useful life. The good news is there's nothing really complicated here. All we're going to do is we're going to plug in what is our current book value, 6,400, minus the revised salvage value, which is now $600 less, right? It was 1,000, now it's 400, and then just divide it by the number of years it's now going to last extra, which is 4. So we're now going to change the depreciation expense each year to 1,500. We don't have to go back and revise what we've done. The 1,800 every year before, that's fine. We don't have to amend that. It's just moving forward. All right, what about additional expenditures? Because it's not like you buy an asset and you never spend any money, right? You're going to have other costs come up. So we have really two types. We have revenue expenditures, and we have capital expenditures. Revenue expenditures, just think about it like maintaining the status quo. As it says, do not materially increase the plant asset's life or capabilities. It's recorded as an expense in the current period, and it's reported on the income statement. All right. Capital expenditures provide benefits for longer than the current period. So think about maybe putting like a new engine in a machine, for example, makes it last longer. These would be recorded as an addition to the asset account. So we're just going to add another debit for whatever we spent on the improvement. And of course, that's going to be reported on the balance sheet because that's where you keep your assets. So kind of a little summary here for you. Ordinary repairs, again, just maintaining the status quo. Those are your revenue expenditures. You can use these three kind of guidelines here. And then anything that makes it better, maybe more efficient, last longer, those are typically going to be your capital expenditures. Again, like major overhauls, partial replacements. And if it extends a life beyond the original estimate, that's going to be a CapEx, a capital expenditure. So looking at the journal entries, if it's an ordinary repair, we would just debit an expense account, and then we would credit cash. In this example, they spent 9,500 on equipment repair. It doesn't touch the balance sheet, doesn't need to. It's just expensed out in that period. If it's improving it, like they're going to use the term betterment, which seems like a strange word, but we can go with that. Then they're going to debit the machinery account directly. That's of course on the balance sheet, and then they're going to credit cash. So they spent 1,800 on some sort of improvement. It says record installation of automated system. So top one, revenue expenditure. Bottom one is a capital expenditure. What about getting rid of plant assets? So there's a couple of things we have to do here. The first thing we do is we update depreciation to the date of disposal because most companies just record that once a year at the end of the year. And then we're going to journalize the disposal by recording cash received. That's going to be a debit because it's going to increase cash. Or if we have to pay money out, that's a credit because it's decreasing cash. We're also going to remove accumulated depreciation. That's a normal credit balance. So if you want to remove it, you do so with a debit. And then we're going to record a gain or a loss, which would be a credit and debit respectively, depending on what the book value is. And then we'll just remove the asset's cost. Again, the asset's been sitting on the debit side because it's it's an asset account, normal debit balance. If you want to get rid of it, you've got to credit that. So the rules are as follows. If cash is this little sign here, you probably know what this is greater than the book value, record a gain. If cash is less than the book value, we'll record a loss. And if it's equal, then there is no gain or loss, right? So let's take a look at an example of discarding a plant asset that's fully depreciated. So it says a machine costing 9,000 with accumulated depreciation of 9,000 on December 31st of the previous year was discarded on June the 5th of the current year. The company is depreciating the equipment using the straight line method over 8 years with zero salvage value. So this thing it cost 9, it's been depreciated down all the way to 0, so there's no salvage value. So this one's pretty straightforward. We're just going to debit accumulated depreciation machinery. Again, that's a normal credit balance, so the debit is removing it, just zeroing it out. And the same thing with machinery, right? We're crediting machinery. That's an asset account, normal debit balance. So if you drop a credit in for 9, you're just zeroing out that account, so it's been removed. What if it's not fully depreciated? So in this example, the equipment costing 8,000 with accumulated depreciation of 6 on 12/31 of the previous year was discarded on July the 1st. The company is using straight line depreciation over 8 years with zero salvage value. So the first thing we got to do is we got to record depreciation expense up to July 1 because the last time it was recorded was 12/31, right? So basically 6 months ago. So the extra depreciation is 500 bucks. The calculation is down here, 1,000 times 6/12. And so we're going to debit depreciation expense, credit accumulated depreciation equipment, just to basically get the depreciation and the book value up to date. And then steps 2, 3, 4. This accumulated depreciation debit 6,500. We're just removing that. We're zeroing it out. Loss on disposal of equipment is 1,500 because the book value was 8,000. And then you can see where we have here the equipment 8,000 is being credited because it's being removed. All right, so what if we sell the plant assets at book value? So on 3/31, this company sells equipment that originally cost 16 and has accumulated depreciation of 12 as of 12/31, December 31st of the prior year. So this company uses straight line depreciation of 4,000 per year, and the equipment is sold for 3,000 cash. So the first thing we'll do is we'll again record the depreciation expense to March 31. We're just going to catch up the depreciation like we always do. So we're going to debit depreciation expense, credit accumulated depreciation equipment for 1,000 to catch it up, get it up to date. And that is again the 1,000 is just 4,000 per year times 3/12 because it's January, February to account for January, February, March. Step 2 is record sale of the asset at book value, 16,000 original cost minus the 13,000 depreciation. So the book value is 3,000. So we have got a debit to cash. We're increasing cash for 3,000 because they're selling it, so they're getting 3,000. That's incoming cash, if you will. And then they're just removing the accumulated depreciation with a debit, and they're removing the equipment with a credit. So what if it's above book value? So here, all this information is the same except for they have the accumulated depreciation of 12 as of the last day of the previous year, 12/31. Again, they're using straight line depreciation at 4,000 a year, and the equipment is sold for 7,000 cash. So they're going to do the same thing here, just like we saw before, because it's the same date, March 31st. So they're accounting for depreciation January, February, March. And then step 2, they're just recording the sale of the asset at a gain, right? The book value was 3,000. They sold it for 7,000, so they had a $4,000 gain. So they're increasing cash by 7,000. They're removing the accumulated depreciation equipment with a debit, again, normal credit balance. Gain on disposal of equipment is being recorded as a credit because they're selling it for 4,000 more than the book value. And then the credit to equipment is just removing the $16,000 equipment. And if it's below book value, so here everything is the same at the top. The difference is now they sold it for 2,500 cash. March 31st entry is the same. So again, it's the same date, March 31st. And then the difference here is that they're increasing cash by 2,500 because it says the equipment is sold for 2,500. They're recording a $500 debit because they lost 500. Remember, the book value was 3,000, and then they're removing the accumulated depreciation and the equipment accounts like before. Excuse me. All right, natural resources. So these are extracted from the natural environment, and they are reported at cost less accumulated depletion. And the total cost is charged to depletion expense, excuse me, over the period's benefit. So these would be things like timber. Their examples: oil, coal, and gold. So let's take a look at an example. These are very simple. So a mineral deposit with an estimated 250,000 tons of available ore is purchased for 500 grand, and we expect zero salvage value. The depletion charge is $2 per ton. If 85,000 tons are mined and sold, the depletion charge is 170,000. So let's figure out how they got the 170. So step one and step two, this is very much like the unit self-production depreciation method. It's almost exactly the same. First thing you'll notice in step one, cost minus salvage value. So the cost was 500. Salvage value is zero. Total units of capacity, they told us, were 250,000 tons. So we get a depletion per unit of $2 per ton. And then it's just a question of, well, how many tons did you extract? It says 85,000 tons. So it's just 2 times 85,000 is giving us the 170. That's it. That's all you got to do. And then this is just a journal entry. We're debiting depletion expense for mineral deposit, and then we're crediting accumulated depletion for the mineral deposits. And as far as the balance sheet presentation, it would look something like this. Again, it's very similar to depreciation and book value. Would have the mineral deposit listed at 500, less the current accumulated depletion of 170. So the current value, the book value, is 330. Or you could just present it, you could just list the 330. So here is the depreciation expense when, excuse me, the depletion, I keep wanting to say depreciation, the depletion expense when some ore remains unsold at year end. So here we've got the depletion expense, mineral deposit of 140. They've got ore inventory at 30,000. So what they're basically saying here is we sold 140 of it. We've got 30,000 sitting in inventory that we hope to sell in the future. And then we're still recording the 172 accumulated depletion. All right, what about the plant assets that are used to extract this stuff? So specialized plant assets may be required to extract the natural resource. I'm sure that doesn't come as a surprise. These assets are recorded in a separate account and depreciated using the units of production method in the proportion to the depletion of the natural resource. All right, intangible assets. So intangible assets, things that you can't touch. So as it says, non-physical assets used in operations. They often provide exclusive rights or competitive advantages, so things like patents, copyrights, for example. They're recorded at the cost when purchased, and they can have a limited or an indefinite life, as we will see. So some examples of the things that we would record at cost, including purchase price, legal fees, and filing fees. So just some examples, patents, copyrights, franchises, goodwill, which that can go on indefinitely. So let's talk a little bit more about patents, copyrights, franchises, and licenses. So a patent is good for 20 years, and it gives the owner the exclusive right to manufacture and sell a patented item or use a process for 20 years. The copyright gives the owner exclusive rights to publish and sell a musical, literary, or artistic work during the life of the creator plus 70 years. And then franchises and licenses, rights to sell a product or service, but only under specified conditions. Goodwill. So Goodwill, I think of Goodwill as a clothing store, but we think of Goodwill as the amount by which a company's value exceeds the value of its individual assets and liabilities. And that Goodwill is only recorded when an entire company or a business segment is purchased. If it's part of a lease, then a company will record what's called a right of use asset, and it's called that because it looks like they own it, but they don't. They just have the right to use it, hence the name. Leasehold improvements to lease property that are paid for by the lessee. And then there may be other intangibles such as non-compete covenants, customer lists, and software. Okay, good. Last thing we'll talk about in this video is, like I always say, when you get to a ratio, it's good times because you're almost done. Total asset turnover. So this is calculated as net sales divided by average total assets. So it's really an efficiency ratio. It provides information about a company's efficiency in using its assets. So you can see down here, Starbucks, Jack in the Box. So total asset turnover, if we look at Starbucks, it's actually decreasing. So they might, and it's decreasing somewhat substantially, so we might want to look at that. Jack in the Box is actually increasing. So Starbucks has got some work to do. Jack in the Box is probably patting themselves on the back. Okay, that's it for this video. Thanks as always for watching, and I will see you in a future video.